Welcome back, Flare community. I hope you're all well and having an incredible day as always. And yes, we've got Property Rich in the house, we've got Professor, we've got Steve Lee, and of course, Who's a Crypto. And yes, in today's video, we're going to be talking all about vaults, how they work, and everything associated with them. First of all, we're going to be listening mainly to this webinar from Sentora, previously known as Into the Block, who are building Firelight in conjunction with the Flare network. But if you are watching this at a later date, please feel free to forward the video by about 15 minutes because we're starting, that's when the this webinar actually starts. So if you do want to hang about or you are listening to this live, we're going to do a bit of a fundamental session on what vaults are and how they're going to be incorporated into the Firelight platform. So looking at this here, this is the Zoom call. This is what we're going to be listening into. What's behind DeFi vaults, understanding vault structure, design, and strategies. So join us on the 29th of October, that's today, for a deep practical walkthrough of DeFi vaults. Centura's experts, contributors to a widely used vaults, will unpack vault types, architecture and strategy, design, and real-world lessons that you can apply immediately. So we've already registered for this. Webinar starts give this a refresh because I think that is out of date. It starts in 15 minutes, as I said, or just under 13 minutes. We've got everything ready here on Zoom, ready to listen in. But before we do that, what we're going to do is just give a quick recap. This is mainly interest to you guys in the Flare community because this is what Firelight will be launching. They're going to be launching various vaults for staking XRP or your FXRP. Of course, many of you know by now you can bring XRP onto the Flare network by bridging it via the very novel F asset protocol. This is a one-of-a-kind bridge. There are no other solutions that bridge assets over to another network in this way. That's what makes Flare so special. But of course, once you bridge your assets over to the Flare network, you're going to be wanting something to do with them. And there is a lot of anticipation here for the Firelight platform, which is basically going to allow you to stake your FXRP in one of the many upcoming vaults. This is the Firelight platform. This is their website. Scroll down here. XRP staking, institutional grade, so ready for institutions. We know there are a lot of institutions holding XRP that are interested in utilizing the Flare network and this platform to earn a yield on their XRP. And, you know, even exchanges that want to forward a yield to their customer base. And one thing that I really like about this is that we're going to see these dominoes falling where we have exchanges that start offering a yield on their XRP, and it's really going to make the other exchanges obsolete. Now, I think we'll start with some smaller exchanges, but as people start to migrate to the exchanges that are offering a yield, I imagine we'll see the bigger exchanges slowly start to integrate with the Flare network, similarly to how we saw with the Flare drop. We saw some of the smaller exchanges start integrating the Flare drop many years ago now, and then there was this sort of domino effect where we would hear news from bigger and bigger exchanges to the likes of Coinbase and Binance that were supporting the Flare drop, but it all started with the smaller exchanges. And we know that we've got crypto.com and Uphold that are very interested in this solution. And again, institutional grade. So yeah, it's going to be a lot of fun. So we're talking about vaults today. Vaults are essentially just a standardization for a smart contract, ERC 4626, and this is what they will be implementing. And basically a smart contract like this with this standard basically has a lot of functions that developers can deploy without having to rewrite how vaults work. A lot of the vaults that you hear about will be of this standard. And let's just talk a little bit of how they actually work. So I created this very simple diagram here, and it's going to really highlight the power of these vaults and how you can compound yields using staked XRP. So we have the F asset system, and let's just assume we've got the users here who are holding FXRP, right? Now we have this vault here, and this is a vault that Firelight could hold, or maybe another entity as well. But we're talking about Firelight today. They're going to have many different vaults with different risks so that you can deposit into a vault that offers a yield that is basically within your risk tolerance. So you deposit your FXRP, it's inside the vault. Now, with that FXRP that's in the vault, there are strategies that are employed that earn a yield, and the yield generates XRP. So, you know, the XRP is growing in this vault. When you deposit your FXRP, you actually received staked XRP. So, you know, you deposit your XRP, you get this staked XRP back, and the best thing about this is that you're going to be able to use this staked XRP in various use cases on the Flare network, in various DeFi applications that I'm sure many of you are already familiar with. So I just want to run you through a quick example workflow of how this would actually materialize into you earning a yield, right? So let's just say, this is a very basic example here. We've got one user and they deposit 100 XRP into this vault. So now the vault holds 100 FXRP and the user gets 100 staked XRP, 1-to-1 initially, right? Now, let's say a period of time passes, let's say it's 1 year. And in that year period, there is a 10% yield that comes from this vault here. So this vault now holds 110 FXRP, right? And the user still owns 100 staked XRP. Now, what would happen is the ratio in which you could redeem your staked XRP for XRP would actually increase. That would be 1 XRP one staked XRP for 1.1 FXRP from the vault, right? So that's how it basically works. You deposit your XRP, the XRP generates a yield while you hold the staked XRP, and when you come to redeem it, the ratio has increased, so you get more XRP back at that moment that you redeem. Now, as I said before, the real secret sauce here is what you're going to be able to do with this staked XRP. You know, this is good enough for many institutions, but if you are a fan of the channel, you know that we are looking to maximize yields, and what you'll be able to do with this staked XRP, while it's still earning a yield within the vault, is participate in DeFi. Now, there are going to be various strategies here where you can have high risk and high reward, or low risk and low reward. So an example of high risk, high reward. So let's say you have USDT paired to staked XRP and you're earning RFLR rewards from that in addition to fees. You could be earning with this staked XRP, and then you can still redeem it for the XRP from the vault at a later date once this has also gained a yield. So it's compounding upon compounding. That's where the power comes in, and yeah, we're actually going to be talking about this a lot over in the Patreon MasterMind group, and I'm actually creating a video at the minute in a similar fashion to this, walking you through a diagram on how things work. I've got it all in this huge document here. We'll talk about that at a later date. Exclusive for the Patreon family, and I'm going to be releasing this video in the very near future. It's going to be a foundational level, so if you are new to the Flare community, it's going to give you an overview of the various opportunities starting with Flare, right? And once we see this ecosystem evolve with the various decentralized applications that are supporting staking, such as Firelight, then we're going to expand the videos, and this is basically just one video in a long series that will be ongoing. And in the Mastermind group, we'll be refining strategies to find the best yields. I'll create a video based on the community and our collective minds together, and then put them out as exclusive videos. And we just keep going through this process of looking out for new apps, looking out for new opportunities, and then putting them to work and start earning a yield. So if you're wondering which kind of applications you may be able to use with staked XRP, you can bet that it's going to be the majority of these. Got Kinetic, more markets, which will probably be using this indirectly. We've got SparkDex, and also, let's say, Enosis and BlazeSwap as well. So yeah, it's going to be very exciting. Just having a look at the dashboard here on the F asset dashboard by Dune, we can see that the demand is still growing. This is the amount of total value locked for XRP, FXRP, and you can see that it has peaked over just, well over 100 million now, hovering at somewhere close to 120, and all of the metrics look absolutely great here. Holdings in the core vault, it's growing, and yeah, I can expect this trend to continue to grow as we see more F assets bridged. Of course, F assets is just for XRP at the minute, but yeah, we'll keep our eyes on that, because with F assets V2, we're going to see numerous assets such as Bitcoin and Dogecoin, XLM, they're going to be integrated too. But for now, let's just enjoy the wave of enjoying the XRP utility that comes with F assets and all of these applications that are finally starting to launch. Firelight is one of them, highly anticipated, and we also have Gnosis with their loans protocol, where you're going to be able to supply FXRP and earn a yield on that. I think they will be integrating staked XRP as well. It would make sense. We're just going to have to wait for more information on that. We've got the webinar scheduled for in just 4 minutes time, so we'll keep our eyes on that. But let's head over to the chat, see what everyone's doing. John Burnett with a bit of a sarcastic comment, I imagine. I'm loving all of these catalysts and prices at still at 1.7 cents. Fleur is really moving, isn't it? Well, just to echo this, I often reply on X here that, if you're investing, right, you look for undervalued assets, right? There's a lot of activity that's happening on the Fleur network right now, and people have been waiting a long time for F assets, right? And, the idea is to buy an asset that is undervalued and then sell it when people realize value, once the price and the value has been aligned, right? You say it's buy low and sell high, right? Not the opposite way around. So we've got all of this great news on the horizon. We're seeing rapid deployments of applications. We've seen the F assets launch, and now people are really starting to jump in headfirst and integrating FXRP into their apps. Plenty of yield opportunities for the community. And yeah, as long as the price is low, I'm happily accumulating here. Some people may want to sell, but, I don't know. With everything that I know and all of the research that I've been and news that I've been following over the past years, I think it's a no-brainer. I think Fleur is providing some real utility for FXRP or XRP, sorry, and institutions are really paying attention. You hear Hugo talking about it. You hear the announcements, Vivo Power, Uphold, Crypto.com, everything blockchain, millions of dollars worth of capital is going to flow into the Fleur network. So yeah, that's my opinion on that. One thing that, talking about the launch of Firelight, I did actually put out a video. It wasn't a video, actually. It was a clip from it was like a similar to like a webinar from Coin Market Cap, where Hugo was talking with Jesus, and who is the founder of Firelight, and he was saying that their pre-deposit Discord bot is going to launch within the next weeks. So, yeah, we're just going to have to wait for that. And I think it's coming soon. But regardless, there's still plenty of opportunities out there while we wait. As I said, I'll go over to the F asset dashboard. Especially these pairs with USDT, a stable coin to FXRP. These are very lucrative. And if you're, smart about it, and you have the risk tolerance, then you can get a lot of rewards. Some of the APYs are maybe in triple digits if you include the fees as well. So Kenneth talking about removing the cap. It's not necessary, to be honest, because if we look here on the F assets dashboard, there's still some available to mint. So if the cap was to increase, there'd still be capacity. The cap would only really need to be increased to meet the demand. But of course, it could only help. They're still rolling it out, but I don't think it's anything to cry about now, because those who want to mint F assets or FXRP
recording in progress
certainly
everyone,
can.
As usual, we'll give a couple minutes, let people trickle in.
Sorry guys, that made me jump a little bit. This guy was just saying that he's going to give it a couple of minutes. So let me just quickly read through some of the comments, and before we head back and we'll listen in, I'll turn the microphone off and join you guys in the chat. Did Jesus say Discord? Yes, he certainly did. So yeah, I'll keep you guys posted as soon as that information drops. You know, you can certainly expect me to post it here or create a video, which, you know, if that isn't a reason to subscribe, then I don't know what is. So yeah, please feel free to subscribe. Also hit the like button if you haven't already, because that always helps the channel, and it's a free way that you can support the work and get people watching these videos, because, you know, that's the way that we get attention, by getting the exposure and getting people to watch the videos, learn about the Flare network, learn about the strategies, participate and contribute to the TVL, the total value locked, and the various activities, the transactions on the network, active wallets, all that good stuff. Right, we're going to listen into this here, and I'm going to mute the mic and join you guys in the comments. So yeah, let's listen in.
As always, these are recorded, so if you're not able to stick around for the entire thing, don't fret. This will be uploaded onto our social channels, so you can come back and revisit if you are not able to stay for the whole thing.
Okay, still waiting, I think. But guys, if there is anything with the volume, you want it turning up or anything, do let me know in the chat, and I'll be sure to do that. But until then, we're just gonna hang about. I guess he's waiting for people to join. Let's see who's in the chat here. See if we recognize any faces. Lewis XRP. I think a lot of XRP people are interested in this because it doesn't mention Firelight, but.
All right, I think we'll get started.
Oh, there we go.
So my name's Gabriel. I work with the research team at Sentora. I'm glad to have you guys all here to join this webinar, where today we're going to be talking about DeFi vaults. So it's a really broad term. There's a lot that's going inside of this. I'm going to focus in on just like a couple specific topics within DeFi vaults, just as they are gaining a lot of traction. And we have seen ourselves that there's confusion between what is a vault, what is happening in these vaults, et cetera, et cetera. So let's dive in and kind of start to unpack that a little bit. So from the table of contents, we can see we're going to kind of talk about the history of vaults, what they are, what their base layer is. Then we'll kind of go into some of the more common types of vaults that we see right now, some of the risks that are involved, and then the conclusions of everything. Of course, as always, some updates from Centura side. We have launched a couple new products. So first one is FBTC vaults. Function Bitcoin is a wrapper style Bitcoin that was initially coming from Mantle, but it is accessible on multiple blockchains now. And we have launched a vault, a private vault that allows for users to utilize different strategies on Euler and different Aave instances. So this one is in partnership with some different centralized exchange earn programs. Really excited to see how this moves forward and being able to help users who are not so familiar with DeFi access DeFi through these earn programs by deploying into the strategies that we run. On top of it, we have some new strategies that we have started running on Aave Horizon. So if anyone's unfamiliar with Horizon, it is the real world asset instance on Aave. So has a couple different assets that are different real world style assets that are publicly traded. And these are yield bearing, and there are some strategies that can be used implementing those by borrowing other stable coins. And this is all live, and we've been running these strategies for some time now, and we're seeing a lot of good growth and demand, which is always beneficial to know that this real world asset is being borrowed by correlated assets, or the other way around, how much of an asset is being used as collateral to borrow a correlated asset. So these can be really helpful to understand what sort of like concentrated exposure you have to one asset that is most likely doing one specific type of trade, which is leveraged looping. This is something that really can become important with how we've seen the validator exit queue go up very high and on how many days it takes to exit. So in an example with ETH, if people are doing this trade and you can see how much of the ETH being borrowed is to utilize this leverage loop strategy, you can start to understand what sort of duration risks that are that Aave's markets are exposed to. So really helpful. Some more information for being able to manage complex trades. So let's dive into it. What are vaults? It's a pretty broad term, and there's a lot of definitions around it. But at its core, for DeFi, it is a smart contract where you can deposit multiple users can all pool their assets into the vault, and the vault is going to be automating yield generation for them. That is kind of the definition that I think is most common now, where anybody can deposit, let's say, USDC into this vault, and then the vault has some sort of programmatic decisions on how to deploy those assets into some sort of strategies that are going to earn yield. The big thing that is quite helpful and has one of the reasons why vaults took off several years ago is that they have this auto compounding design. So you don't have to claim your assets and then convert them back, claim your yield or incentives that you've earned, claim them back into your underlying token and redeposit. It does all of that for you. And this was really helpful in the beginning with a lot of like avoiding high gas fees on Ethereum, back in the 2021 era when we first saw these vaults really take off. And then also with these vaults, to varying degrees, they're non-custodial, meaning that you can just withdraw from them anytime. We'll get a little bit more into that later on, but yeah, so usually you're able to just withdraw your assets when you want without having to have or having minimal unstaking periods or delays with no one else controlling if you can or can't withdraw. So to go into the base layer of what most of the vaults we see are today on Ethereum mainnet, they are ERC 4626 tokenized vaults. So how these vaults work is that you're able to deposit one asset into the vault, then you get a fungible share token of that vault, which represents how much of your deposit you have in the vault relative to all the global deposits in that vault. That's what's called the receipt token, and it represents your share of the vault. And so this is what's being used to track not only your initial deposit, but how much of the yield is allocated to you, and you have the right to withdraw when you decide to exit the vault. So this diagram, I think, is a fairly straightforward diagram of how it works. Is that you have the users depositing into the vault. These deposits get deployed into some different types of strategies by varying degrees of percentage of all of the tokens deposited here. One thing that we don't see in this diagram is that once you've made the deposit, you would be getting that receipt token back. So that usually shows up in your wallet after you've made that deposit, and you can see it there. And the difference between the exchange rate or the receipt token and the first asset that's been deposited is some sort of exchange rate defined by the vault. So you're always able to get back your initial deposit plus any sort of yields that you have accrued since. So let's take a look at what vaults looked like kind of right when they first launched, when ERC 4626 standardization came into effect, and what they look like now. I think probably the most well-known one is Yearn Finance from the early days. So this initially was a single strategy, really looking to farm the incentives that were happening in back in 2021, et cetera. There was 1,000% APRs on certain tokens, and so Yearn was able to capitalize on this by creating these vaults where people could all deploy their assets there. They would farm the tokens that were being generated at these ridiculous APYs, and auto compound those for the users, because as people know from back in that day, it was you would be sometimes paying like $300 or $500 worth of ETH as gas for a single transaction. So the really big benefit from this was that users were able to avoid paying this gas all the time, and the scale of the vault was able to make the economies of scale essentially, made it much easier for the vault to do this harvesting rather than each individual doing it themselves. Yearn V2 came out not that long after, which created the vault structure that I think we see a lot today, which is allowing for multiple strategies per vault. So rather just having it be one strategy on the vault, you would have maybe multiple pools on some sort of AMM that you were depositing into and farming all of those pools at once. And this allowed for, as we would call it, the set it and forget it rather than this manual process, which, while it seems like maybe it isn't something that would be as important for people that are in DeFi, actually this ability to deploy your assets and then have a lot of this work done for you, we have seen be quite popular because there is a lot of complexity, and the complexity just grows as new blockchains, new protocols join the ecosystem. So being able to kind of delegate a lot of this work to somebody else has a very beneficial impact for a lot of retail users and also institutions. Yeah, so just a quick item. Feel free to ask questions in the chat or in the Q&A section. I'll probably get back to most of them at the end of the webinar. So moving on to modern vaults, I have two of them that with the definitions that I have made, I think that these can be kind of pretty broad definitions that most people would accept. But one caveat to all of this that I think is important is that the nomenclature around vaults, specifically in DeFi, is a complete mess. So it's something that you always want to take into consideration when you're trying to deposit somewhere, to make sure you understand what you're depositing into, because one product on one protocol might have the same name as a completely different product on another protocol. So this is always something to DYOR on, to make sure that you aren't making any mistakes on what you're trying to deposit into. But with that said, earn vaults, these are usually quite simple, passive yield on one asset. I think the most well-known version of this is Morpho, since they kind of pioneered this design, which is you have what they're called metamorpho vaults, that you deposit one asset, let's say USDC, into that asset, into that vault. That vault distributes all of the USDC that has been deposited into individual markets on Morpho. And so for a user who's just planning to lend and they just want to get yield on their USDC, this is a very easy way for them to deposit into this vault, and it's going to be getting higher rates usually than something like Aave, because there is someone called a curator that's making sure to delegate the allocations of all of the USDC in that vault into these different markets to get the highest risk reward return for the assets that have been deposited. We'll dive into some more details on that one coming up, but the other vault that is also been quite popular and maybe has less clarity on like the nomenclature around it is what I'm calling multi-strategy vaults. So think of Veda, think of so the EtherFi liquid vaults, some of the Berachain vaults that were initially deployed, Lombard vaults. So these are vaults where you deposit an asset into it, and the vault, the strategies in the vaults aren't tied to that one protocol as the earn vaults usually are, but they can be deployed into multiple protocols and strategies all at once. So the big difference here is that they are chain and protocol and strategy are agnostic, where the earn vaults usually are a bit more structured into what sort of strategies and deployment use cases they go into. So they're all built on top of this ERC 4626 design structure, but they vary greatly in the scope of what the strategies are, the complexity, and the risk. So as an example that I was showing before is with Morpho, you have kind of this example here where you have two suppliers. They want to deposit into two different vaults. So think of ETH Vault 1 as maybe being the Steakhouse ETH Vault on mainnet, and then ETH Vault 2 could be the Gauntlet Vault on mainnet. So they're both accepting the same asset, but once you've deposited that asset into the Earn Vault, it's getting distributed to different submarkets within Morpho. And so in this example, you have these final markets here, let's call them, where you have a pairing of two assets. So ETH, which is the asset being lent out, and then STETH, CBETH, or SDAI, which are the collateral assets that are being used as collateral to borrow the underlying ETH. And so again, how this setup is that these curators, which in this example are Steakhouse and Gauntlet, they manage their vault by distributing the ETH into different markets to get the best risk return reward as they see fit. And the users can look at these different vaults and decide, they think that the collateral in this one is too risky. They like the returns on this one. And so they choose which vault to deposit into. And then they don't have to do anything else. When they decide that they want their ETH back, they just have to withdraw. So quite easy. specifically that these are especially on Morpho, these are very non-custodial vaults. You can withdraw whenever you want if the liquidity is there. And Morpho makes it very easy for people who are supplying to the markets to withdraw when they want. Again, so here are some examples. Morpho Euler Earn, which is a newer product that is built to do the same thing as Metamorpho into their entire vault system that they have. So a little bit more complex, but kind of accomplishing the same thing. And then this isn't just Ethereum mainnet specific. These earn vaults happen other places, specifically Camino Earn has seen a lot of success. It's not built on the ERC 4626 design because that's obviously Ethereum virtual machine-based logic. It's Solidity code. Theirs is a bit different, but it's practically implementing the same thing. So after earn vaults, we have multi-strategy vaults. As we said earlier, it is really focused on one single asset being diversified across multiple strategies all at once. They're protocol and strategy agnostic. So a Veda vault, for example, could just be deposit your USDC here, and then we run strategies on all sorts of different protocols and blockchains. What we tend to see is that there are kind of like, let's call them theme vaults. So EtherFi has their own vault that is deploying into strategies. Lombard has their own vault. Berachain, blockchains. There was the Veda vault for Plasma that really people heard a lot about because they got so much free deposits there. And so these assets all get aggregated there, and then they get deployed into maybe some sort of specific set of strategies within the ecosystem to help benefit the ecosystem that the theme is based on. So within this, instead of curators, there are strategists or like a controller logic within the vault that rebalances all of the different strategies based on yield, risk, and liquidity. So as people are wanting to deposit or withdraw, it's going to be rebalancing all of these strategies to make sure that it can satisfy all the conditions that have occurred. For example, there's a large amount of withdrawals, you might have to start unwinding one of the strategies to make sure that you can satisfy all of those withdrawals. And so this design definitely captures a broader yield and usually can have higher yields compared to an earn vault because it has more flexibility to choose new strategies as they come online, where the earn vaults are usually contained into the protocol that they're built on. And they reduce concentration risk. There's definitely other risks that do increase, but instead of having everything just focused on one protocol, it has multiple protocols that it's in. So, if there was some sort of exploit, your eggs aren't all in one basket. And then again, some of these, I think the most well-known one is Veda and its boring vaults, but you do have other examples like Concrete, Upshift, and then IPOR is kind of the more unique one out of the other three because it is a protocol that has these vaults. It has somewhat of a similar design to what you might see on the other three vaults, but it's all built into its own protocol that it runs, where Veda, Concrete, and Upshift often get deployed into, they get launched on another protocol to help generate some sort of liquidity and attraction for that specific protocol. IPOR has all of its vaults housed in its own protocol, where you can access these different vaults from their front end. So the thing with these multi-strategy vaults is that you can start building some interesting products on top of them. So not only can they deploy into multiple strategies, they can also, potentially do some off-chain stuff as well. And so you can start to see things like yield-backed stable coins, where maybe they're running some sort of basis trade strategy that's similar to Athena as part of the subset of strategies that they have. And then you get what these protocols often call a synthetic dollar that starts at one, but starts to accrue in value as yields come in. But to specifically say they aren't pegged to the dollar. So there is a chance that if there is some sort of issue within their strategies, that the yields that you have seen accrue can be lost, and so it can be worth less than $1 as a full disclaimer. But we're seeing a lot of these different yield-backed DeFi strategy stablecoins launch, and they all have a very similar multi-strategy vault structure to them. And then, as I had talked about before, themed vaults or sometimes index vaults, which are less popular. The themed vaults are usually the one that we've seen a lot of: the Berachain pre-deposit vault, Plasma pre-deposit vault, Liquid, etc., which are the ones that we usually see. And they're often the underlying infrastructure is provided by one of these three protocols in most cases: the Beta, Concrete, and Upshift. So what are the differences? I think it's pretty easy to summarize. So scope, earn vaults are usually with a single strategy. Now there are some updates from like Morpho and even Euler that could start to broaden that out, and possibly Aave as well. But as of right now, that's the kind of the design where multi-strategy vaults, it's in the name, they run multiple strategies. Architecture is usually one vault, one protocol. I mean, there can be multiple vaults within one protocol, but everything is contained in the protocol that it is based on. Where for the multi-strategy vaults, as they are agnostic, they can be deployed and managed across n amount of blockchains and protocols, as long as everything can come back when people want to withdraw from the main entry point that they deposited into. UX, earn vaults are definitely much easier. It's very streamlined. You deposit, you see the yields. They're kind of often organic yields, so it's very easy for them to account for. On the multi-strategy vaults, it's a lot of coordination. There's often cooldowns, position unwinds. There's a little more friction, definitely, as of right now on these vaults, because first, the accounting on all of the yields from these different venues is quite complex. And if a large whale wants to withdraw from the vault, it can have a big impact on the strategies and positions that are in this vault. Sometimes there's a certain amount of duration that is locked up into the vault. And so unwinding these can sometimes take time, where that's where you see some cooldowns that end up happening, where it maybe takes a couple days. Often it's built into the whole design, but it can take a couple days to make sure that everything is accounted for correctly, and then you're able to actually withdraw your assets. The yields, earn vaults, are usually quite steady, outperforming just depositing into a single market, but not as high as multi-strategies, which can be much higher, but definitely more variable. There's a lot of often points and airdrops that are involved in some of these strategies. So these can have a quite variable effect on what sort of returns you get once those rewards are realized. And then for control and custody, earn vaults are usually very non-custodial. It's exactly the same as depositing into Aave or any other lending protocol. You are able to withdraw that whenever you want instantly. There's not an issue there. Where on multi-strategy vaults, as I said, there can be some time locks. Even though it is non-custodial, there's built-in time locks just to make sure that everything runs smoothly. And then on the curator inputs, the curators are on earn vaults are usually very well defined what sort of parameters they have, and it's usually constricted a little bit. Where curators on multi-strategy vaults, it's essentially what they decide. So you're putting higher trust assumptions onto these multi-strategy vaults than sometimes you would on an earn vault. sometimes it can be the other way around, but often the case that you're relying on team and operational execution to be at a much higher standard on multi-strategy vaults than the earn vaults. What sort of risks can you see? Classic ones, smart contract risks. These always exist. When you think about it, for the earn vaults, it's usually just one layer. Maybe sometimes you could call it two, but it's just what's in the protocol. On the multi-strategy vaults, these layers can be very complicated because you might have multiple different protocols that the vault is deploying into, and maybe these protocols deploy into some other sort of strategies on different protocols. So this one can become very complex. So it's always important to try and understand and weed out how many smart contract layers there are, because this starts to increase the potential risk vectors that you might have. Yeah, this ties in with the underlying protocol risk and then the operational risk. While I did mention it in the previous slide for multi-strategy vaults, there have been some instances on earn vaults where the curators have maybe allocated a heavy amount of what assets were in their vault into pool pairings that were, or market pairings with risky collaterals that have ended up in precarious instances, or even the curators have lost some assets from there. So while there is more restrictions on what the parameters are, curators can manage on some of these earn vaults. It's still, they need to allocate into different markets and make adjustments if they see risky situations happen. And then regulatory censorship. I mean, this kind of hits everywhere, but this probably is something that is more on multi-strategy vaults, that you need to make sure that one protocol that you're managing in doesn't have some sort of issues that shuts it down while your assets are in there. So these are always things to keep in mind. And then strategy-specific risks. I think most of these are related to the multi-strategy vaults, but impermanent loss, because you can be deploying into AMMs with volatile pairings, liquidity withdrawals, these cooldowns and fees for entering and exiting, and duration risk that I mentioned, market and price risk, of course, leverage and liquidations. It kind of connects to the duration risk that I had mentioned, but essentially, a lot of these multi-strategy vaults do run some sort of looping strategy, where they're either looping Athena-based, as a good example for stablecoins, Athena-based assets with idle stablecoins like USDC or USDT, or they're doing it with ETH. And so the questions are, how easily can whatever size position of this strategy be unwound if it needs to be? And if it can't be unwound immediately, how long would it take for it to unwind? And would it be at risk of liquidation during that time? So these are some of the questions that need to be answered. And then I think most recently we've seen this on the October 10th flash crash, is imbalanced delta strategies, where, as I said, a lot of these multi-strategy vaults are running basis trades on different venues. And with this flash crash that happened and the auto deleveraging being put into effect on some of these different exchanges, it left certain people in a position where their delta neutral hedging, the two legs that they use for the hedging of this delta neutral strategy, were not in balance, and this can expose them to the depositors in a risk where there's a liquidation that they aren't able to, the protocol isn't able to resolve, and that could end up being a loss on the larger vault itself. How to monitor risks. I think checking for audits, always important. Reviewing the collateral and strategy exposures of these different vaults. So making sure you yourself understand at least the gist of what some of these collaterals are that they're deploying into, or how much concentration they have. If it's a strategy that is 80% running this leveraged loop trade, maybe this is something that makes you concerned and you don't want to deploy there. You'd rather deploy into an earn vault that can't do this sort of looping trade. Monitoring parameter adjustments from the curators or strategists. I think this is quite important. On the example I have here is from Centora's Euler Risk Radar, where we track for each of the different vaults governance updates that have been made by the risk curator. So this is an example from our Centura RLUSD vault that we have on Euler and Ethereum mainnet, showing all of the adjustments that have happened: borrow cap, supply cap changes, interest rate model. So tracking these can help you get an idea of how well the curator is managing the risks that they perceive in the marketplace, to at least know that they're maybe actively doing it, or you can also check and see if they've become quite aggressive over time, just to make sure that they have the highest yields in the marketplace. And then real-time transparency on any of these, which us at Centora have indicators for Euler and for Morpho. So these are two of the bigger earn curation protocols. I'm sure that my colleague can share our risk radar in the chat, where you can explore Euler V2 dashboard and the Morpho dashboard that we have. In conclusion, vaults are becoming almost commoditized and becoming this vault as a service, where it's very easy to spin up a vault and use it to provide financial services for end users. Earn vaults are much easier, and they are probably the best suit for someone who wants to reduce any sort of risk exposure, but still, you want to make sure that you see that the curators are adjusting properly over time. Multi-strategy, while they're quite helpful in attracting a lot of yields just based on their scale, they can attract yields that are harder for retail users to manage and deploy into. These are things that you definitely want you want to make sure that the strategies are transparent. You can easily see them, and you want to make sure that the team, the audits, the risk limits, concentrations on strategy and collateral, and how withdrawals can happen are all in line with what your perception of the product is. And then again, nomenclature is not standardized at all, which is really difficult even for people that are working all the time in this field. So always try and double check and make sure you understand exactly what the product is you're looking at. Our next webinar is going to be AI-powered research, uncovering alpha and DeFi markets. This is something that we've been doing a lot of work on. I think it was just shared in the chat to sign up for that. With a lot of these LLMs really making huge advancements in the last year, it's something that we work on and use quite a lot. How we can harness this to discover new opportunities, discover new things, and become more efficient in our space, being able to react faster to different market scenarios. Thank you. Now, questions for anyone? Yes, there will be a recording available in the socials. I think an email will go out for it soon enough afterwards, once we have trimmed it, make sure that it's all correct and the audio is good. Are vaults designed primarily by institutions for retail and high net worth individuals, or smaller asset managers the primary clientele for vaults? I think a lot of the vaults that you see on, like for example, Veda vaults, I think that these are really, while institutions might be interested in them and high net worth individuals, these are really helpful for retail because they might be able to access certain strategies that maybe themselves they wouldn't be able to on their own, but by deploying into the vault, they can. That being said, I mean, there are instances where maybe there are institutions, like I think often if there was an institution that wanted to deploy into a vault, they would probably make their own vault. I don't know if that would be the same case for high net worth individuals, but institutions, we're seeing a lot of vault style developments happening on the centralized exchange front with their earn programs. So this is a way that they're able to bring the DeFi opportunities to their centralized exchange users. And so this is something that we'll see grow a lot in the coming year. Can you explain basis trades and delta strategies are? So the basis trade is what Athena does. So I would recommend looking into their documentation. This is probably where you can get your best.
Okay, guys, I'm going to call that there. Yeah, there was some things in the comments, and I wanted to show this specifically for Kirsty. I just need to find out where this post was because I posted it quite a while ago. But it talks about, you know, TVL, total value locked. We've seen this go up considerably over the past, I don't know, couple of weeks at least. You can see it here. TVL increasing since May, especially since USDT launched. I'm just trying to find a post that I want to talk about because it's very much relatable. You know, TVL is a precursor to price because TVL, total value locked, brings a lot of attention to the Flare network. And yeah, the price is pretty low right now. It hasn't really done much since we've seen this increase in total value locked, but you know, they're not synced all the time. Here we go. This is a great example. So I'm going to actually read this verbatim just specifically for you, Kirsty. So I hear it all the time. F asset minting cap increased, but let me start that again. F asset minting cap increased, but price go down. Or TVL increased, but price go down. We just yeah. So for clarification, the amount of FXRP minted or total value locked does not directly influence the price. Price is established purely through supply and demand economics, the price people want to pay for FLR and the price that people want to sell FLR. The launch of F assets has been a huge success, and the demand for generating yield on XRP is extremely obvious. The Flare network has highlighted a unique value proposition in recent weeks, which may attract more investors who believe in Flare's future, just like you and I. That drives demand, which drives price, but it's important to acknowledge that FLR is part of a much larger market, the crypto market. So we saw that huge liquidation happen just a couple of weeks ago, and this is the thing, the market moves in lockstep. Those who have been around for a while will know that the broader market usually moves in tandem. So take that point into consideration if you're using F assets minting cap or the total value locked to assume prices. Yes, they are loosely correlated, you know, a potential increase in demand, but there are many variables at play. The golden rule is to buy if you think an asset is undervalued and sell when you think it is overvalued. It's as simple as that. With that in mind, I'm of the opinion that Flare has huge growth potential evidenced by its success of F assets alone. But let me tell you this, the best is yet to come. We've got trusted execution environments, we've got protocol managed wallets, the Flare data connector, the Flare time series Oracle, F assets v2 and Flare smart accounts. These are going to be absolutely huge, and FXRP or F assets are just the tip of the iceberg. So that is pretty much the video. I'm not going to hang about for the Centura questions at the end. I thought it was absolutely incredible. It's really good to get a better understanding of how these vaults are actually working. And yeah, if you're interested in joining the Patreon, about this video here, the big mind map, how everything works. And that's going to be the first in many series on how to basically get ahead of the game, where the best yield opportunities are. You can find a link in the description below. So guys, thank you all so much for watching. Don't get disheartened about the price. We're just going to have to keep our eyes peeled, and it seems like Firelight is just around the corner. I'll be creating lots of content and guides and walkthroughs on the channel, so if you are interested in subscribing and want to find out how it all works, then feel free to do so. I do hope you have an incredible day as